All right. So let's kind of do a deep dive into the 10-year yield, what it means to us and what it means for the markets. So first off, what is the 10-year yield? So your government treasuries, U.S. government 10-year treasuries. So when you buy a 10-year bond, you are essentially lending money to the government. And if it's a 10-year bond, then they're gonna pay that back to you plus interest in a 10-year time frame, right? So it's the government's debt that they are paying back. This is a safe investment because it's backed by the government, so they'll always pay back their debt, right? Now, if you're thinking, well, I don't know, I understand there's a conversation there, but that's too far for this. For the purposes of talking about finance. When the only time we can use the word guarantee in finance is when we're talking about government bonds. So we have to assume that the U.S. government is going to be good on their debt. So it's a safe investment. Now, a general way to think about the 10-year yield is, so the 10-year bond in particular, you have your short-term bonds, your 1 year, 2 year, and then you have your long-term, your 20-year, 30-year. With the 10-year kind of being in the middle, the 10-year is used really as a reference point across the board for things like our mortgage rates and things like that. It's really the staple that is looked at more than any other duration is the 10-year yield. So when we think about the yields and the prices of these bonds, they move inversely, right? So when we buy a bond, so there's two components of a bond. We'll just kind of get into like a lesson here on bonds, right? So two components of a bond. You have the price of the bond and you have the yield of the bond. So the price is like the actual price you pay for the bond, whether it's, par is like 100, right? So you say you pay $100 for a bond, or maybe if it's lower, if it's at a discount, you pay $94 for a bond, or and at a premium $105, so on. So that's the price you pay for the actual bond. The yield is the interest rate that bond is paying you. Okay, so again, two components: price and yield, and they move inversely to each other. So if I get out my little drawing here, right? So if you ever taken like a Series 7 or something like that, they always tell you, it's like a seesaw, right? So yields go up, prices go down, and of course, the inverse. If yields go down, then prices go up. Obviously, I'm drawing with my mouse here very fast, so this is not good artwork, but that's essentially the rule with bonds, right? So prices and yields move inverse to one another. Now, why is that? They tell you on a Series 7, use your pencil and do the little trick there to remember that how they move. But why is that? Why do prices and yields move inverse to one another? Well, it's because the market is a market, right? There's your CFA level 2 lesson for the day. The market's a market. Who would have thought, right? So if I have, let me get rid of this here. So if I have, say I bought a bond and it's paying me 5%, right? That's horrible, but whatever. 5% bond. And and then I'm holding that bond. It's paying me 5%, and I'm gonna get 5% return on my money. But then interest rates go up, and so now if I were to buy a new bond, it's gonna pay me 7%, right? Well, let's say the price I bought this bond for, I bought it for $100. Okay. Well, now, how much? So when they issue this bond, the 7% bond, it's also going to be $100. So it's a market, right? Okay. If someone wants to buy my 5% bond, well, why would they pay $100 for it when you could pay $100 and get a 7%? Because interest rates are higher, right? So the price of my 5% bond now would have to go down, because you could pay $100 to get 7%. So clearly, if you're going to get a 5% bond, it's going to be cheaper, right? The value of it's gone down, right? So that's why bonds, prices, and yields move the way they do. So hopefully that makes sense. And hopefully you gained value. And maybe if I'm being a good YouTuber here, I would tell you that if you're enjoying this lesson, give a like on the video and subscribe to the channel. And I'll try to give more valuable content like this. So anyway, tying this back into the 10-year yield. Now that you know what you know about bonds and the yields of bonds and how they affect the prices, let's talk about how the 10-year yield is affecting the market and how we can sort of think about it. So we saw when the Fed began to cut interest rates, which is around this time frame, the 10-year yield went up. So that's kind of interesting. They're cutting rates. The interest rates are supposed to go lower, right? Well, then why would the interest rate for the 10-year bond go higher? I thought they were supposed to go lower if the Fed cut rates. Well, don't forget, it's a market, right? So think about this in terms of the flow of money, right? The flow of money. So people got excited when the Fed cut interest rates. So they sold their bonds. The money moved out of the bonds and into the stocks, right? Interest rates are lower. I'm excited about the future. I don't need safe investments anymore. I want to take risk because I'm excited. So that's what investors did. So this is the 10-year yield, right? If we go into ZN, that's the actual bond itself. The price of the bonds go down, right? If people are selling, let's get that stupid line out of the way. All right. So this is basically inverse to your 10-year yield. If I put this up here, 10-year yield. Okay. Right? So this is the price of the bonds. This is the yield of the bonds, right? So people are selling their bonds, right? So the prices are going down. There's sellers. When there's sellers in a market, prices go down. More people selling than buying. Prices go down, yields go up. Why are they selling bonds? Because they want to put it into the market to gain more return because they're optimistic about the market, right? So that's that flow of money at play, even though we had a Fed rate cut. Okay, so now we saw the 10-year yield go up because the safe investment, if people are going to move their money into riskier and riskier investments, the yields have to go up to attract buyers, right? So down here, nobody wants 3.8%, right? So these yields got to come up to attract people to buy, right? Oh, it's an auction. You want 3.8%, you want 3.9%, you want 4%, you want 4.1, 4.4 up here. Oh, okay. So now we're attracting some buyers. If I look down here again at my price, now we're attracting some buyers. Okay, people like 4.4% for bonds. They're willing to forego taking on the risk of the riskier investment because now these bonds are paying what we'd like, right? So that's the flow of money. Hopefully all that is coming together and making sense. Yields have to go up to attract more investors. So now what's interesting here, and what I want to point out, is these yields rose, right, to attract buyers into bonds because buyers were moving out of bonds and into stocks. Now they're starting to come down. The yields are starting to come down. And of course, we see that means, from what we learned earlier, the prices are starting to come up. So what does that mean? That means people are now moving money out of stocks and into bonds, right? And this is a daily chart. So this is over the past 1, 2, 3, 4, 5, call it days since the bottom here. So just in the past week or so, you're seeing a flow of money again into bonds because the prices are going up, the yields are coming down. We talked about how the markets were at highs, but our growth stocks, our NASDAQ, our tech stocks are lagging a little bit, and we're seeing the money shift from risk into safety. What does that mean for markets looking ahead? I'll let you be the judge of that. Start to think for yourself. Could that mean a potential pullback if the money is shifting towards safety? I don't know. So hopefully you enjoyed this video. Again, give a like, subscribe to the channel, and comment below what you found interesting or any questions I can answer. And share it with your friends, and I will see you guys next week. Again, don't forget to subscribe to the newsletter. It's totally free. I don't sell anything. But subscribe to the newsletter so that way you get it in your email inbox, whether it's a video like this or a written form on Substack. Make sure you're getting the newsletter. And again, I don't sell anything. Okay, it's Dalton Grados. I will see you guys next time.